investing in retirement has changed dramatically over recent years. Thanks to the pension freedoms introduced in 2015, people have now got a lot more flexibility about what they do with their money. Most of them now choose to stay invested through their retirement, and they can use their money in ways that they couldn't do before when they had to go buy an annuity. But that also brings a lot more responsibility because you've got to make your pension pot last. So to help us unpick that and how to invest in retirement, I have Justin Urquhart Stewart of Seven Investment Management and Matthew Yeates of Seven Investment Management here.
Evening, Simon.
Good evening.
So, Matthew, when people are thinking about what they want and what they need from retirement, what are the things that they need to consider first of all before they even start thinking about how they invest?
Yeah, so I think in many ways you talked about pension freedoms, and I think they came on a theme that had been going on in pension provision for so long, and that's the step back of supposedly defined benefit schemes. What did defined benefit schemes give you, and what did an annuity pre-pension freedoms give you as well? Well, they gave you a guaranteed income for life. A guaranteed income for life that many times was linked to inflation. And so you had a very good picture at that point of retirement of exactly how much you were going to get every year. I think now with pension freedoms, that frees up more flexibility. Without defined benefit schemes, that frees up more flexibility. But people need to think about things like, what is the life expectancy that's relevant for them? People know that they're living longer, but men on average still underestimate their life expectancy by 6 years, women by 8 years. So getting a handle on how long they want their money to last. Freedoms mean more potential to leave and bequest money to the next generation. You know, how much thinking about what they want to leave to the next generation, whether that's part of their planning, and just really sitting down and thinking what their expenditure looks like. No longer is it going to be kind of set for them in terms of how much they're going to get every year, but people can have a think about, okay, what works for me? What's reasonable for me? And putting all of those things together in a plan starts to just give you some variables that you can then work around to manage the risk around not meeting those objectives.
And Justin, when it comes to the actual bit where they might be investing to last them the rest of their lives, why is investing in retirement so different now?
Well, you only have to go back a few years and you'd get people still getting these things called lifestyle funds. And traditionally they were always advised, and many people remember, used to be told the percentage of gilts and bonds you had was the same as your age. Not quite sure when you get over 100 how that works, but no matter. So the whole idea is when you retired, therefore you'd have 65% in bonds or something like that, different types. But that's all changed now. It has to change. Why? Because we've had 25 years of a bull market in bonds, which in English actually means as the yields have been coming down, the capital value of those bonds and gilts have been going up, which is brilliant, fantastic, if you'd retired 25 years ago. However, we now know interest rates are rising. I don't know, I haven't heard the news out of the United States tonight, but there's a very good chance rates have risen there, and they will go up here as well. And that means the capital value of all those bonds that people have worked so hard to get and been advised to get, or been given in their lifestyle fund, which has got that sort of built into it, is now giving them greater risk. We have the 10-year gilt was always nicknamed in the city the risk-free investment, because a government gilt was never going to go bust. The risk-free investment is now risky, and no one's told anybody about it really. And I look around the industry, and in many ways they don't seem to accept it either. So I still see an awful lot of portfolios, frankly, stuffed with these bonds at a time when they shouldn't be there. They may have some that are going to be very short duration, but actually when you're looking at sometimes personal injury funds, when you're looking at funds, money that you can't afford to lose, which has got to actually be de-risked, not increase in it, particularly at the moment when you're trying to retire.
And Matthew, the problem is that investing wisdom said, countervailing investing wisdom said bonds are there for two things. They're there, A, as the safe part of your portfolio, that counterweight to those risky shares that you hold, and also to provide you with a steady income. But what's happened means that that's not necessarily the case anymore, doesn't it, as Justin said?
Yeah, no, and I think you can look back, people have been calling the end of the bond market for a very long time. Okay, people have been calling the end of yields dropping steadily and bond prices increasing for about
25 years they've been calling.
Exactly, and I think in many ways on that first one, that income component, I can say objectively, without making any prediction about what's going to happen in future, that you are getting paid less income than you used to. The 10-year gilt yield, 1.5%. So you get paid for lending to the UK government 1.5% for 10 years. The diversification bit, that's what bonds used to provide you as well in your portfolio. You know, they used to be the counterweight, the offset to that growth part of your portfolio in equities. Well, you don't have to look very far the last 2 months to see a period when that didn't happen. Look what happened in the US. Okay, so you had the S&P 2 days where it was down 4% in a single day at the start of February. Bond yields were rising through that total period of the sell-off. You know, I think that's the really profound thing. And as Justin said, if I look at year to date and I look over the last 3-6 months, what has been the big sell-off that catches my eye? It's not the equity market falling and then recovering much of its value in the US at the start of February. It's bond markets wiping 3 years, 4 years of income off their capital value in that same period. Why is that important, and why is that important for investing in retirement? Because those are the low-risk assets. People understand that equity markets might draw down. Were people expecting the bond part of their portfolio to lose more than the equity part of their portfolio when there's a big sell-off in the equity market? I don't think so. I don't necessarily think that was the case.
And those portfolios were designed in those days because when you retired, you lived another 5 or 10 years and popped your clogs. Now, we've got another 35 years to go, and we'll be gagging to go by the end of it. We have got a choice, of course. We can go to Zurich if we so wish, or potentially Guernsey if they start introducing it there. But see, we're not going to do that. Then we've got to take a different view. For investments now lasting 30 years means you're going to have some growth. You're going to have to take some risk in that.
And Matthew, we think about it, again, there's the sort of countervailing wisdom of once you get to your retirement years, you switch from growth to income. Mm-hmm. But that's not necessarily how people need to be thinking, is it? They need to be thinking about both.
Yeah, I think so. I think when it comes down to, we can talk about 100 minus your age in bonds, we can talk about your age in bonds, we can talk about the 4% rule in retirement, and you know, that's a sustainable level of income. All of those were built for the historical world. And in many cases, some of those rules come from 20, 30 years ago when people were living less long, they were certainly working for less long. And you say, you know, what is that pinpoint that you switch from going from growth to income? Well, that's a very difficult thing to answer, and that's very individual to the person that you're talking about. People don't usually, or don't fix their retirement at 65 and walk away forever now. People are going to partial retirement, people are working for longer. And I think when it comes to investing for income versus growth, for most situations, you're taxed almost the same on income versus growth. And I think if you look at that drive towards income-producing stocks, or that drive towards income-producing parts of the fixed income market, actually just driving towards that one goal in your portfolio, natural income as it were, may actually lead you to the riskier parts of the market. Look at the safe dividend-paying stocks. They are frequently now the most highest valued parts of the market. If you look at the income-paying parts of the fixed income market, you know, if you want to pay or you want to find a 5% yield on a bond, you have to go to emerging market bonds, you have to go to high yield bonds. So just driving towards that natural income, I think, may actually lead people to much more risk than they potentially need. And the one thing we know about investing in retirement is you only get one chance to get it right. So that's when that risk management really matters. People say take more risk in accumulation. Why? Because you have the ability to bear those financial losses when they come. I think just striving towards an income portfolio may lead you into more risk and more tail risk exactly when you don't need it, which is in retirement.
And Justin, do people also need to think in a more broader sense than just their pension? That's my pension pot, that's the bit I need for retirement.
Absolutely, and broader in various senses, you know, because you can see where the government's moving now with regard to pensions and ISAs. The government they don't like pensions. Why? Because they have to give you a tax break on it, and they don't get any tax income until you start taking money out of it. Whereas an ISA, that's tax-paid money you're investing. They've already got the money in advance. That's why they've been boosting it up to £20,000 each year, every single year. So you have to look at the whole range of your assets, and then planning. And this thing about the financial planning is so vital to make sure that you're running those pots down over time in order. And so therefore, it's not just the return on the pension, the return on the ISAs, and the return on things which actually may not have those same tax wrappers. The other bit of this, so I think on a broader scale, it's not just you, it's also the family. And we're very bad at this country normally doing it. You know, we don't ever sit down as a family and talk about money. No, good heavens, we can't spend more than 3 days together at Christmas without trying to throttle each other. So we're hardly going to sit down and say, let's talk about our portfolios. But actually, if you coordinate across the family and across the generations, from great-grandparents, grandparents, parents, then you'll be dealing probably with a larger sum, and you can properly plan it, not just for your retirement, but also for the grandparents' healthcare, also for education, and it's a broader scale, rather than just necessarily looking at the narrow issue of just your pension pot. That's what we've got to do, and the good news is there's now much more software and various apps you can use to really help you with that, to make it easy.
Now, Matthew, we talked about the problem with bonds, the safe part of your portfolio, but also with some of the most popular shares, some of those really defensive, income-based stocks. So where else can people look? What are the alternatives?
Well, you finished on it, alternative assets, I think. I think one of the real problems with alternative assets are that frequently they come up against that burden of illiquidity, and you come up with, lockups and high fees. And if you look at, I suppose, the institutional market and what defined benefit schemes, the world's largest pension funds, who, let's be frank, they can lock their money up and they pretty much know when that money is going to come out for 100 years. Actually, 20% of their assets on average, if you look at the biggest schemes across the world, are invested in these alternative assets in things like property and things like private equity. But they come down to those liquidity problems. And I think when we're providing solutions for retail investors and individuals, we need to try and find liquid alternatives and liquid solutions to that same problem.
And it's one example I saw the other day of this in one of the portfolios I saw that a client had, where the alternatives were in second-hand aircraft. Now, there's a market, I grant you, but actually, that's hardly liquid, and so something like that is wholly inappropriate to have. Yes, it can be an investment, but really you're going to be pretty specialist to understand it, and that issue of liquidity is vital. If you can't trade it, you're stuck.
So it's not just a case of thinking outside the box and going, oh, well, that's completely different to the other things I'm investing in. Oh, I'll go for that. That sounds a bit unusual. But it's maybe thinking about going perhaps for some value rather than the traditional expensive defensive companies that you might be buying.
Things to look at. Traditionally, you and I talk about classic cars sometimes, and people often talk about, there's an investment return. But of course, those markets may not be liquid, but they're movable if they work, but they're not regulated. So you've got no protection on it. And classic moments like this is when you see people coming up with their wine portfolios. Obviously they are liquid, but in a different sense. But the whole point there, again, it's not regulated. How much of that wine is real? Do you actually know what you're dealing with? And so you've got to be really very careful. So I put those to one side. That's in the Bitcoin pile, as far as I'm concerned, of areas we don't necessarily need to be considering. But there are other alternative assets that we can look at, and we've been looking at some of those, haven't we?
Yeah, I think if I just think of a few examples off the top of my head, I think many of the things that hedge funds used to do, and you used to have to pay 2 and 20 and lock up and have no transparency into what they're doing, are now available for other investors. Things like long-short equity funds, you can now get on very kind of good rates of fees. Assets that some people have problems with in commodities, things like gold. You can certainly get now access to cheap gold funds. I'm not saying gold is the be-all and end-all alternative, but certainly it's shown some potential to be diversifying historically. A final one that we've been looking at recently and put into the portfolios is protection against inflation, an explicit protection against inflation. And if I think about the real risk to portfolios for an investor over the long term, it's that inflation spikes much quicker than expected. What caused the bond sell-off at the start of the year and over the last 6 months? Well, it was very much those fears of inflation coming to the fore. That's what caused the equity market to sell off. At least that's the narrative that the market hung the hat on to start with as well. So I think when we think broadly, there's some opportunity in things like long-short equity funds, things like gold, things like inflation protection. And many ways they can be delivered in a liquid format that are not locking their money up for too long, and we think can be delivered cost effectively.
There was another one which I thought was fascinating that actually came up, which was UK mortgages. Now, as soon as you mention mortgages, people immediately go, oh my God, subprime, it's going to be a disaster. But those were American mortgages, not UK mortgages. In America, all you have to do if you don't want your mortgage anymore is you throw the keys back.
Hence the term jingle mail.
Jingle mail, I think it's wonderful. And so in 2008, 2009, piles of envelopes with keys turned up. In this country, you can send your keys back. They'll say thank you very much indeed, but they're still coming after you. They'll come and get every single asset, including the child, which could be useful sometimes, to actually get their money's worth. So actually, we don't foreclose very often in this country. So UK mortgages at the right level can provide you a liquid fund of tradable with a good steady income, which is unlikely to see much in the way of foreclosures. And of course, that's not dependent on the equity market or the bond market. And so just a simple thing like that, which most of us can get our heads around and sort of understand, actually, it's not as risky as the headline would apply.
I suppose one of the pitfalls, obviously, with things like that and with anything that we're talking about is the idea that you don't just go all in on that, isn't it, Matthew?
Yeah, I think it's about everything in a balanced portfolio context. And when I think about an allocation to alternatives in our fund, it's not like we're moving 100% into alternatives. Bonds aren't dead, for sure. There's still a place for bonds in a balance, in a multi-asset portfolio. But I think just relying on bonds for that diversification, if equities are going to be the growth of your portfolio over the long term, it's about diversifying your diversifiers that little bit more than potentially you needed to do historically when yields were at 5% and you had a little bit more surety that bond markets were going to provide some protection when the equity market sold off. That hasn't been the case in the last 1-2 months. And I think if I was going to make one prediction over the next year, 2 years, I think that is probably going to be the same case again. Bond markets may not provide the diversification they used to.
Right, chaps, thank you very much for that. We're now going to throw it open to some questions from people from the audience, if anybody would like to ask any questions. We do have a man roving with a microphone, so if anybody feels brave enough, gentleman over there.
Hi guys, I'm Mike from Truffle, thanks for that. Something I've been looking into is actually silver, and as you know you can get exchange traded funds for that. What's your views on it? It's a good sort of hedge against a sell-off of equities. It's still it's seen as undervalued at the moment with the gold-silver ratio. So what are your thoughts on investing in that?
Yeah, I think silver is one that people lump in with gold quite a lot. It has some commercial applications, as does gold. I think when people are making a view on precious metal commodities like silver, like gold, I think you have to ask yourself about the kind of environment that you're going to be in. If you're in an inflationary environment, then that tends to be good for those sort of metals. If you're in an inflationary environment but yields are rising very quickly, what do people say about gold? What do people say about silver? The reason people demand them is because they can't get the yields on their nominal bonds. So if you think inflation is going to rise quicker than the nominal bond yields are going to rise, then it's probably a good place to be. I think I'd lump it in with gold, and the relative valuation of gold versus silver, it's hard to make a call on in any one period in time, but I think those tend to be the main drivers. Do you think inflation is going to rise quickly? If you do, it's probably a good place to be. Do you think nominal yields are going to rise very quickly? If you think they're going to be a little bit slower than would be implied by inflation, then it's a good call.
But the other metals like copper and zinc, they'll be different because they'll be much more linked to how the economy is doing. So we've seen in the past year, you saw Brazil and you saw Chile all suffering hugely from the price of iron ore and copper. Now actually you've seen that come up really quite considerably. Why? Because there was more demand, and also the industry was rationalising itself, taking out production. So still metals, but a different way of looking at it.
Thank you.
Any other questions? Gentleman over here.
In terms of alternative assets, you didn't actually mention the hedge funds or specialist absolute funds. Those funds that are looking at going long or short and stuff like that, with a view to maintaining your investment. Could you give me your opinion on those?
Well, you've got a choice of ones here, and some of them are pretty well established. I'm not going to go into particular names, and there are some which have actually had quite a good track record, but more recently have sort of, because they got so large, they found it very difficult to sustain it. And you look inside them, and it's very difficult to understand all the different structures they're using. So it's a melange of different investment styles that they've got, which is fine when it's working. But you need to understand what they're actually doing, and some of them will actually end up sort of operating against one another. So you're going to be really quite careful. What's written on the absolute return funds over the past few years have achieved a bit of a reputation of returning absolutely nothing. So be really rather careful. The hedge funds themselves, and I think this is a good point you actually made, the structures they're using are interesting. There's no reason why, unless it's difficult for the individual to do it, but investment firms can't actually do exactly the same portfolio structure, but without the hedge fund charges on it. Remember, the hedge funds have very generous charges. Remember, the primary benefit of the hedge fund is going to the hedge manager, not to you. You're right at the end of the list with it. So use the practices of it, but don't necessarily actually use those particular funds.
I support that. I think hedge funds are not an asset class. Hedge funds are a legal structure which many different things can sit inside, and many times it's the fees of that structure, it's the lockup of that structure, it's the lack of transparency of that structure that's actually the bad thing. Sometimes the underlying strategies, as Justin said, can be very interesting. I think of hedge funds in the same way that I think of ETFs or a mutual fund. They don't tell you any more about what's being done in the underlying, they tell you a lot about the nature of the wrapper that it's in. And I think, as Justin said, many of the strategies that used to be just used by hedge fund managers can now be replicated by liquid, UCITS, mutual fund managers. You know, things like long-short equity funds, you don't have to go and pay 2 and 20 anymore for. So I think there's interesting strategies that are going on inside hedge funds, or used to be only going on inside hedge funds, that we can look for and get access to without necessarily saying hedge fund fees for them.
I think there is actually another interesting point on hedge funds as well, which is relevant to a certain Mr. Warren Buffett, who made a bet against some hedge funds, a 10-year bet, and he won that with his tracker fund. But the interesting thing about that I don't think he actually went into enough in that shareholder letter, is there were 5 funds of funds that he invested in, and each of those funds of funds were invested in a certain number of fund managers. And effectively what you had there was not necessarily the case that every one of those hedge funds did a bad job over 10 years, but the fact that they were invested into so many different hedge funds that effectively their strategies were pretty much cancelling each other out. And you do need to be careful when you're investing to look at your portfolio and make sure that all of the things you're holding aren't just cancelling out the good stuff that the other things are doing, don't you?
Yeah, and I think on funds of hedge funds, the problem with that is, if it's a hedge fund with a hedge fund inside of it, what were those nasty things I talked about before? Fees. If you've got fees on fees on fees, then you're going to end up paying away a lot of fees, and you're probably not going to have much of a return left. So that drive that I know Jordan talked about at the start of low fees, looking for those opportunities but not necessarily paying fees, and certainly not paying fees on fees, that's going to help you kind of get a lot further down the line.
And the transparency of it, so you can actually see what's going on, and more to the point, that we can understand what's going on. It's one of the problems we've got in this country. We have never been taught about finance. We've had to learn it almost by mistake. The industry doesn't really teach people. They'll give you a book to go and read or something like that. I want to see personal finance being brought into schools as part of the maths curriculum, so people then coming out have a better understanding of simple things like compounding. And then also from that you can then understand how some of these strategies and hedge funds work. They're not actually that complicated, but we make them sound complicated. Why? Because, it's part of the investment mystery, don't worry, pat you on the head and we'll patronise you.
Well, it would certainly help school leavers understand why they shouldn't be charged RPI plus 3% on the £9,000 student loans.
Yeah,
that
we're absolutely
borrowing.
right. Yeah.
Any more questions? Lady over there?
On the last point that you're making about reaching out to younger people, do you do any outreach to younger savers, say anyone under 40 with a real income and literally confused about what to do for their pension?
Yeah, it's a fascinating thing actually that we didn't develop because we're frankly not bright enough, but some of our clients, they wrote the software Donkey Kong, the game, and they sold their business for a totally obscene sum of money, but well done them. Anyway, we got the great privilege of looking after some of it. It's all online, it's all invested for them. We suddenly realised they didn't understand it. So we said, right, okay, so right, sit down, we're going to have a little joint venture here. We want you to write your game software, our world. How do you then make a pension look like a software game? No, to actually therefore, so people understand what's in it, how it works, show them a world which spins round, you can muck around with the play. It sounds rather simplistic, doesn't it? But it makes it interesting. You can't make it entertaining, it's a bit flippant. But people can then get to understand it. And we've done that on an app, it's free, you can just download it. And that with also something planning for the future. It's on something called 7Imagine. If you go to 7Imagine, My Future, download it, and we take this to schools and take it to universities. And it's fascinating because, of course, the kids get it straight away and start mucking around with it. And the whole idea is you put in what your family's like, you know, husband, wife, family, various children, those you are up to, and things like that. The houses, what the investments are. Put in your date of birth. Obviously, from that you can calculate. Therefore, roughly when you're going to die, you can move your death. You can move other people's deaths. Just don't tell them. But it then tells you when does the money run out. And that gives you an idea. So if you're leaving university, and if I started saving into an ISA, starting in a pension scheme, what's the effect of how much I put in? And how much do I actually need? Because you tell people to get £20,000 worth of income, you're going to need £500,000, they sort of pass out. But if you tell them actually it's only going to cost you 2 Starbucks coffees a day, and you just did that every day and invested that, then you say, I get that. Now it's more understandable.
Yeah, I'd add to that. I think it's absolutely the right question to be asking, because what do we know? A lot of the conversation today has been about investing later, when you're approaching retirement or in retirement. But what do we know is important with retirement planning more than anything else? It's starting early. And starting early, even saving a very small amount, is so very, very, very important to where you end up. Actually, early on, it's how much you save, rather than whatever you do with your investments, that makes the largest difference to your outcome over time. So the earlier we can engage people and get people on the idea that saving even a very small amount is going to make a huge difference, the better.
And the other thing I always say to people in their 20s who ask me about their pension, for example, I said this to my own sister, is that basically there's two things. Firstly, because of the magic of compounding, if you do it for 40 years, you end up with twice as much as you would if you did it for 30 years, which is great. So start 10 years earlier and you'll do yourself a favour. And the other one is, if I said to you, if you give me £50, I'll give you £112.50 back, what would you say? And most people will go, oh, that sounds like a good deal. It's like, well, you pay £50 into your pension, your employer will match the £50, and you'll get £12.50 in tax relief. That's £112.50 for £50, and that's a good deal. So pay the £50.
Yeah.
And I think we need to talk to people more in that kind of language, because I got a pension statement the other day from our pension provider, I'm not going to name the company, and it told me the value of my pension as of the 6th of April 2017. And I thought, great, that's brilliant. That was a year ago. I could have looked that up online any one of the last 300 and however many days. So
no, I think that goes down to the point that Justin was talking about, and engaging people with their pension over time. The more people are engaged with it and they can see it over time, I think this is what people need to work on. How do we report on the money that people already have? How do we report better on the money that people are going to have in the future? Because that's what actually engages them with what they have. People talk about BP or Shell doing X, Y, Z in the news, and they realise that if they have a pension scheme, they are probably a shareholder too in those companies through their pension scheme. Getting people involved in the stories and realising that the stock market affects everybody that has a pension is the first step, I think, towards not just making people's retirement savings better, but getting a better kind of culture for shareholder kind of capitalism, really.
It's this issue of giving yourself confidence. Confidence actually that you're going to be all right. We're frightened about it. But if we can actually just make sure that we're going to get steady returns over time, and that's enough that we're going to need, then that's going to give us that confidence. Personally, I blame Hugh Edwards on the BBC. At 6 o'clock news, you watch that every night, listening to a depressed Welshman telling you what's happening in the economy. It's hardly surprising people don't have much confidence. If, however, we got our finances properly sorted out for a longer term growth, irrespective of whether your views on Brexit or most things in the economy, you and your family are going to be all right.
Okay, that's all we've got time for in the first part of the show. Justin, thank you very much. Matthew, thank you very much. Thank you very much for your questions. We're going to take a short 10-minute break now, where we can all refresh ourselves, and then we will get started again at about 7:45.